Much research has been undertaken on why people make certain investment decisions. Do we digest information properly and make the correct investment decisions? If not, why not? Well, advisory partner at Citadel, Christelle Louw, joins us for more on that one. Christelle, thanks so much for your time today. So this relates to behavioral finance, right?
Correct.
What is that?
That is actually the filters you use when you make investment decisions. You know, how you take your investment decisions, what has actually affected that? You know, what has created that filter? It may have been experiences that you've had or material that you're reading.
Okay, also our biases, I suppose.
Absolutely.
And what people around us are saying as
That's
well.
right, and I mean, that is the filters that I'm referring to. For instance, experiences that you've had. We've had clients that we advise, and then they've got certain biases to exposing themselves to market risk.
Yeah.
And that comes from experience where they were working in a bank. And in 2008, 2009, they saw the crises. And because of that, they've got a complete bias towards taking that risk.
Okay.
And we call that anchoring bias.
Okay.
Whereby they anchor in certain experience that they've had.
Okay.
And then have a resistance to actually entering into a scenario where they get exposed to that type of risk.
And another one is confirmation bias. Tell us about that.
That's very interesting. Confirmation bias is once you've taken an investment decision. For instance, you've decided to invest in the euro, or let's say the dollar rand exposure, have investment exposure, and suddenly the rand is now strengthening. So it goes against your thinking that the rand's going to weaken all along. And now you're looking for information that's going to support that.
Okay.
So you're looking for confirmations, any snippets of information. The danger with that, of course, is that you're anchoring on a certain view that you have. And you're limiting yourself to actually being exposed to objective view because you're so subjective towards having to confirm that the decision that you've made is really the correct one.
Which then could lead you to having further losses because you are staying in that position, even though it doesn't make any sense in what is actually happening in the
Absolutely.
market. Over-optimism?
Over-optimism, we often find that. Talented self-believers. In the scenario where you deal with clients, it's perhaps not that strongly set, but perhaps in the case where there's expectation, where the markets are going to improve. And the South African market's going to improve, and because of that, you overexpose your weighting to the South African market as opposed to having more balanced exposure. And that is the overconfidence, because you're so convinced that this is the scenario that's going to plan out, that you don't build any other scenarios around that. And that can lead to very dangerous losses. Because of the overexposure, and also the fact that you stay in the market then for much longer than what is actually typically needed.
And you also don't diversify because you so believe that particular narrative that you'll stick with. Cognitive reflection, what is that?
Cognitive reflection is the differentiation between the gut feel that many of us have. You know, when you actually deal in the market, when you've made a few purchases, you create a bit of a gut feel, but it's the differentiator between the gut feel and doing actually the studies and the research to ensure that you really have the backing and the facts. It's perhaps for the individual that's a little bit more patient, the individual that's prepared to go that extra mile. But once you have that information, it's how you use that. And the interesting thing about that, Ziki, is that people that actually have that bias is often quite willing to take risk, but very, very reluctant to take any losses. So what I'm saying is you do the research and you enter into an investment decision and have investment exposure. But at some point when you suffer some losses, you're very uncomfortable about that. The other thing about the cognitive reflection is that the way that information is presented to you in marketing material may either trigger you to engage and actually invest in something like that or actually put you off. It depends on how it's set. For instance, if the marketing material up front says there's certain losses that can be incurred, that individual's already on the back foot. Whereas if it starts off by saying, but this investment is relatively safe and you can actually secure certain capital, then you're more interested in engaging.
That's interesting because it's the same, the result will be the same either way, it's just how it's presented.
Yes. I suppose the question is then, how do you How do you manage these biases?
Yeah. How do you first figure out which one you have?
That is with behavioural science.
I think I have all of them.
Yeah, with behavioural science, I suppose that is the first thing you have to do. You have to identify and recognise that you have certain biases, because that can actually cost you a lot of money in making your investment decisions. So identify what biases you have, and if you don't know, I think the best way to go ahead is to deal with the investment professional, to get objective advice. In our business, we often don't look after our own funds. We hand it over to one of our colleagues that's got objective views of your funds, because it's the normal emotions that actually creep in, the fear and the greed.
And it's your money.
It's your money.
We'll leave it there. Thanks for your time.
Thanks.
Today, advisory partner at Citadel, Christelle Louw.